Hi, everybody. Welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. So today's topic, as part of the Ask Patti Brennan series, is about annuities. And let me just come clean with all of you. I'm totally agnostic as it relates to this issue, right? I'm not one of those advisors who says we would never recommend an annuity, and I'm not one of those advisors who, thinks an annuity should be part of everybody's financial plan, because guess what? It's not necessarily true in either case. So what's right for you in your situation based on your risk tolerance, your sources of income during retirement, your cash flow, what you want for yourselves and your families. That's the most important thing. So first thing to look at when you're considering this as an option are the threshold issues. First of all, do you need it? Sometimes having that mailbox money, that guaranteed stream of income that you can never outlive, is kind of important, because living on interest and dividends, for example, on a portfolio may not cut it for you. So having more to cover the essential needs that we all have might be comforting for you. It supplements what you would receive, for example, in Social Security. So first and foremost, do you need it? What's your cash flow going to look like? What does it look like today? What would it be? What would be the implications if you took a chunk of money out of your portfolio, whether it be your retirement plan or your non-retirement plan? Because you can invest in these things using either option, okay? We're going to go through pros and cons of each, but that's first and foremost. How much have you accrued? What are the implications if you remove that from the portfolio? And by the way, how does that make you feel? Because this is something that you may not, you may not turn on this tap for 10 or 20 years, right? So it is important to understand the implications. Now, let's first talk about the three types of annuities. You can get a fixed annuity, which is kind of like a CD, right? You've got a fixed term, it pays interest. When it matures, you can keep it in the annuity and get whatever interest rate the company's offering at that time. So that's option number one. You can get one of these variable annuities that basically is kind of like a bunch of mutual funds in a annuity contract that would be tax deferred. So that would be maybe attractive with your non-retirement money. So it's tax deferred mutual funds that could turn on a stream of income that you can never outlive. Now, today, we are not going to get into all the different riders that are available on these things, because that gets very complicated. And some of these riders sound really good, but in reality, you're paying a lot of money for them, and they really don't necessarily do what you think they might do. So fixed, variable. The third type of an annuity is basically just fixed based on a particular index. And those types of annuities have caps and participation rates. So if someone says we're going to give you this type of contract that is based on an index, you got to ask that question. Well, okay, if the S&P 500 does 20%, does that mean I get 20% on this wonderful guaranteed annuity? The answer is probably no. Understand that going in. Or plan B is, okay, it may not have a cap, but you get 10% of the S&P. So there are certain nuances to these contracts that it's important for you to understand how they work. Again, they can be fantastic, though, especially for those people who are looking for peace of mind in that season of life. The other consideration is, do you need more growth than what these things might be able to offer you? Because there's costs and fees, and it's not like, I believe in transparency. We charge clients fees. They know exactly what they are. In these things, you sometimes don't really know what you're paying, and boy, some of them are really expensive. Now, it may not be in the form of an expense ratio. For example, it may be in the form of an opportunity cost. For example, like those other types where you're going to get 10% of an index. Guess who's keeping the rest? The insurance company. That's your fee. So Just really, and by the way, that might be okay. Totally okay. Run the numbers. You know me, I'm going to preach it till my dying day. It's okay as long as it's okay. It's different for everybody. Just run the numbers and make sure that it's okay for you. Because again, there's a lot to be said for being able to sleep at night. That peace of mind, that confidence knowing you've got this money coming in every single month from this insurance company. And probably won't surprise you, because it's an insurance company, it's like the banking system, right? You got to make sure it's a solid company, because if you're investing in something like this that you're not going to collect on for 20 years, you got to make sure the company's going to be around 20 years from now. Again, very, very important, because annuities are not FDIC insured. There's no such thing as SIP insurance. None of that stuff applies on annuities. I think also the consideration would be the tax implications, because retirement plans are one thing. You know, you put your money in. When you start taking it out, it's going to be ordinary income. You're going to pay tax on it. With the non-retirement annuities, they're kind of interesting, because when you put the money in, if they grow or when they grow, you're not paying taxes every single year on that growth. When you start to take money out, basically it's subject to this thing, LIFO, from a tax perspective, last in, first out. So what that means is that when you start taking money out of the annuity, you're getting taxed at your tax bracket at that time. The other thing that is an important consideration that you know before you go into this is that annuities do not receive something called a step-up in cost basis. So you put $100,000 in, you never touch it because you didn't need it, which is perfectly fine. The beneficiary then receives the value of the contract. Let's say it's now worth $200,000. There's a $100,000 gain on that annuity. You pass away, they're paying taxes at their tax bracket at that time. So they don't get this thing called this step up in cost basis. If you invested in a portfolio, and if that portfolio had that same experience, 100,000 became 200, well, the kids would inherit the $200,000, but they wouldn't have to pay taxes on any of the gain. They only pay taxes on the gain from that point forward, depending on whatever they do with it. So that's a nice little loophole that an annuity doesn't provide. So certain considerations. Now, a potential perk of the non-retirement annuity is, let's say you turn on the tap, you put in $100,000, it's now worth $200,000. There's something called an exclusion ratio. Only half of it is included in your taxable income. Now, the actual calculation is a little bit more nuanced, because the amount that you get every month and every year is going to be based on your age at the time. It's an actuarial calculation, but I think you get the drift. Not all of that monthly income will be taxable to you in that particular year. So again, for a lot of people, they like the idea of having that regular stream of income, and the fact that all of it may not be taxable is a nice perk. Other things to consider would be, if you do turn on the tap, be really careful about the options that you choose. For example, think about this as a pension, right? And really, it just kind of simplify this. What is an annuity? Let's go back to the basics. What in the world is an annuity? The annuity is a purchase of a future stream of income. That's it. You put in a lump sum, and at some point in the future, you're going to get income for the rest of your life. Or if you're married, you can choose joint and survivor. If it's important for you to leave money to beneficiaries, kids, friends, whomever, then you can choose a different option. And this is why this is so important, because that might be, it would be a bummer if you say, okay, pay me this monthly income that I can never outlive. You turn on the tap. That's an irrevocable decision, kind of like a pension. And let's say that you don't live for the 20 or 30 years that you hope to live. Well, you collect for 1 year, that $200,000 evaporates. It goes back to the insurance company. So be very careful what option you choose when you start thinking about receiving that guaranteed income, because that choice is irrevocable and it could have significant implications on the surviving spouse as well as your estate planning and what you end up leaving to the kids. So that's just a kind of a brief overview of annuities and things to consider. Remember, there are 3 types. Contracts are crazy complicated. Make sure that somebody's getting into the weeds so that the advisor understands what exactly they're recommending, because I got to tell you, a lot of times they don't or they forget. I will tell you, we have to keep track of it because they're always changing. So we have a database of the different types of contracts that clients have, because they all have their if this, then that, their nuances, their rules. And if you break their rules, forget it, all bets are off. So 3 types of annuities. These things can be wonderful for certain people, and they may not be appropriate for other people. I will tell you, the one bias I do have, and I'm just going to, again, come clean. The one bias I have is don't let anybody recommend, I would say, 1/3 of your portfolio into this type of contract, because once it's there, you can't really get it back out again. And sometimes life happens and you might need that money. So be very careful. And it may sound phenomenal. Gosh, I've heard people pitching this stuff. Even I want this, right? So the pitches are phenomenal. Just be very careful, okay? And understand that they are sold, not bought, and understand that sometimes there is a conflict of interest in all of that. So with that in mind, I want to thank you for tuning in today, listening to this wonderful, boring subject called annuities, but they can be appropriate in the right situation. If you have any questions, go to our website, keyfinancialinc.com. Thank you so much for tuning in today. Thanks so much for your ideas on what you'd like to hear about in the Ask Patti Brennan series. Have a terrific day.